You may remember the story from just a few months ago when Nadine Ahn, who was the former chief financial officer at the Royal Bank, she was fired due to an undisclosed personal relationship with a colleague. Well, she is fighting back. She has filed a lawsuit against the bank, and she's claiming wrongful dismissal after being fired due to this undisclosed personal relationship with her colleague. Now, Ahn had been considered to be a potential candidate for the CEO position, and she alleges here that her termination has caused her significant professional and personal damage. She served RBC for 25 years and became the CFO back in 2021. She asserts that her employment record was spotless. She was unfairly dismissed over the allegations of favoritism towards Ken Mason. This is a colleague with whom she had a close personal relationship. In the lawsuit, it states, over 25 years of employment with RBC, Ms. Ahn proved herself as a loyal, trustworthy, and extraordinarily talented leader who overcame many gender-based hurdles during her employment. Now, both Ahn and Mason, who was also fired during this clearinghouse here, they're both suing for tens of millions of dollars in damages. They're arguing that the bank's public statements falsely implied an improper relationship and unjustly tarnished their reputations. Now, RBC has denied these claims. They stated their decision was based on a thorough investigation that revealed a significant breach of the bank's code of conduct. Now, again, according to the lawsuit, it says, this discriminatory and unbalanced misstep by RBC ended the career of a woman who was a candidate to be RBC's first female chief executive officer and caused colossal professional damage and personal and family embarrassment and privacy damage for RBC's loyal long-term employee, Ken. Now, RBC, they're fighting back on this. In a statement issued by spokeswoman Jillian McCardle, she says, these claims are without merit. We will vigorously defend them in court. We conducted a thorough review with an investigation by outside legal counsel, and the facts are very clear that there was a significant breach of our code of conduct based on the irrefutable evidence collected during the investigation. Now, in the lawsuit, Ahn is seeking nearly $50 million in damages, citing again this global reputational harm caused by her dismissal. Mason is pursuing over $20 million for himself. We are seeing a surge of insolvencies in Canada's real estate sector, with the number of insolvent companies and projects on track to surpass levels seen even during the global financial crisis way back then. Rising borrowing costs, construction costs, these are putting intense pressure on the developers, and particularly those, of course, with less financial resilience. Insolvencies in the real estate, rental, and leasing sectors have been steadily increasing, with an average now of 20 cases per month. That's from January to May of 2024. To some, this hasn't exactly come out of the blue. Colin Doran, he's the head of development advisory for commercial real estate firm Altus Group. And he says this has been a long time coming. And he adds there are no doubt more real estate projects in distress, but it's hard to tell how many can be worked out before ending up in an insolvency position. We expect there will continue to be more unsophisticated developers in trouble. Now, if this trend continues, by the end of this year, real estate insolvencies could be 57% higher than they were last year in 2023 and 13% higher than in 2009 during the financial crisis. So that sort of gives you an indication here of the magnitude of this problem. And if that's not bad enough, to make it even worse, these figures don't even include the growing number of projects that have entered into receivership due to unpaid debts. Now, we've heard stories of several of the high-profile developments. The poster child there has to be Sam Mizrahi's luxury condo in Toronto called The One. They have also defaulted on loans. It's just a sign, perhaps, of the widespread challenges that are facing the industry. Now, this project, The One, is one of the highest profile projects to default. It owes its lenders $1.6 billion. Developers now, they're finding it more and more difficult to pass on these costs to buyers. It led to a slowdown in pre-construction sales and growing financial strain there. According to Stats Canada, the cost of construction rose 10% from 2017 to 2018 in the Toronto region and 8% across the country's major centers. This harsh truth is that as the market adjusts to these new realities, the number of distressed projects and bankruptcies is only expected to rise further. Are you looking for a smart way to invest your money and achieve your goals? Well, whether you want to diversify your portfolio, access innovative solutions, or align your values with your investments, BMO ETFs and mutual funds can help you. BMO ETFs and mutual funds offer a range of products across different asset classes and geographies. They're designed to suit your needs, your preferences. You can also benefit from their market insights, which will help you become more informed, make more informed decisions, and hopefully optimize your returns. Don't miss this opportunity to potentially take your portfolio to the next level. Contact BMO ETFs and mutual funds today to discover how they can help you shape your future. Visit bmogam.com today. That's bmogam.com today to find out more. What would it be like if, in fact, the U.S. president could influence the Federal Reserve Board's decision? Well, that is the poll question in this weekend's Pulse newsletter. Do you agree with Donald Trump's suggestion that the U.S. president should have a say in Federal Reserve interest rate decisions? I will put a link here to Saturday's newsletter. You can weigh in with your thoughts. I really would like to hear those. I will publish the final results in this coming weekend's edition. If you're not already subscribed, go ahead and give it a try. My goal with the newsletter is just to sort of provide a tight, informative recap to the most important stories of the week. I'm sure you will find it valuable. You can click on the QR code here to join the crowd. Investors have been making large reductions in their equity exposure, particularly this past week, and this now marks the steepest decline since the onset of the COVID pandemic. According to data from Deutsche Bank, the aggregate allocation to stocks fell to the 31st percentile, and that is a huge drop from just 3 weeks ago when it was near the top of the historical range. That was in the 97th percentile there. So this reduction in equity, this is sort of reflecting the growing concerns about a potential U.S. recession. It has led to this heightened volatility in the markets that we've seen recently. Especially the volatility has been evident here in the tech sector, which has driven most of these more recent sell-offs. They were leading the up and they're leading the down as well. Notably here, the decline in the equity allocations, that implies investors are expecting a slowdown in corporate earnings. Projections are now pointing to low single-digit growth compared to the 11% increase that we saw in the second quarter. Now, analysts are expecting a more moderate rise in the S&P 500 profits in the coming quarters. And that reflects the uncertain economic environment that we're seeing ourselves in here. Systematic funds, these are the funds that automatically adjust their exposure based on market conditions, and they are expected to face further pressure to reduce those equity holdings if this volatility persists. Scotiabank announced plans this morning to acquire a 14.9% stake in the Cleveland-based KeyCorp for approximately $2.8 billion US. This deal will see Scotiabank purchasing shares at a price that represents an 11% premium to KeyCorp's recent trading value. Shares of KeyCorp are trading up at exactly 11% this morning. Now, this move comes as part of Scotiabank's broader strategy as they're shifting the focus towards North America and the Caribbean. KeyCorp, they focus on commercial and retail banking, and that should fit well with Scotiabank's U.S. capital markets operations there. Now, Jefferies Financial Group analyst John Aiken, he said, while this is a very different approach to gaining traction in the U.S. market that has been taken by its peers, we are not sure about how much Scotiabank will gain in synergies. The transaction here is set to proceed in a couple of different phases. Initial investment, which will be closing in Scotiabank's fiscal fourth quarter of 2024, and the remainder, of course, pending further regulatory approval. Overall, the acquisition is a real reflection here of Scotiabank's recent strategic pivot towards North America. It aims to enhance its presence in the U.S. market and to capitalize on opportunities for growth in commercial banking. That is all for today. Thanks very much for watching. We'll see you in the next video.